Next, we're going to see this mini example how we're going to construct financial statement. So we start with this company's balance sheet. Previous year's balance sheet. What we have is assets, liabilities, right? The total assets equals total liabilities. Then we're going to see transactions for this period. Right, first, the company paid $900 to advertise in the local newspaper during the May. So paid cash reduced. Now, on the accounting equations, then what we need to do to balance? If we reduce cash, then we need to reduce either liabilities or equities. And here we're going to reduce equities. And to be more specific, we're going to reduce earned capitals because, right, the newspaper advertisement is an expense. Expense reduce net income. Right, remember? And if we reduce net income, our return earnings will be reduced. So earned capital will be reduced. So in terms of journal entries, we're going to debit expense, to be more specific, advertisement expense, right? That's $900. And we reduce cash. So we credit cash $900. Right, so we finish the journal entry. Next we have paid $1,500 for inventory previously purchased on account. Now, previously purchased on account, which means we own vendors. $1,500. Now we paid off our liabilities. So assets, cash reduced by $1,500. On this right hand side, liabilities is also reduced by $1,500. Okay. And if we reduce liabilities, we decrease account payables. And we credit cash. Right, next, the company sold $600 energy drinks to customers for $2,400 cash. Okay, so here we have two things. On the one hand, we're going to record the revenue, and on the other hand, we're going to record the expense related to these transactions. First, let's record the revenues. For the revenue, we received $2,400 cash, so cash increased. Okay, and our equities increased. To be more specific, revenue increased by $2,400. Okay, so I'm going to record a journal entry. Remember, it's paid cash, so it's cash sales, not credit sales. So we're going to debit cash. And a credit sales revenue. Increase cash, increase revenues. And on the other hand, we're going to record expense because, right, we sold $600 energy drinks. That's our cost, sales cost. So we reduce inventory. Inventory will be reduced by $600. Okay? At the same time, because we have expense, our equity will be reduced by $600. To be more specific, that's an expense. That's an expense. Cost of goods sold. Cost of goods sold. So I'm going to record the journal entry. We increase the expense, cost of goods sold. That's $600. And we reduce our inventory, $600. All right. Next, the company sold $700 energy drinks on account for $2,900 to a convenience store. So this is also sales transactions, but it's sales on account, which means customer have not paid yet. But the same thing. We have provided our goods, so we recognize revenues $2,900. $2,900. Yeah, I think it's a typo here. Right, revenue increased to the same transactions. Revenue increased $2,900. Now this time it's not increase in cash, but increase accounts receivable. Okay. And the same thing, we're going to recognize the expense as well. That's a $700 expense will be recognized. So it's the same journal entry. That's $700. All right. Next, the company paid wages total $1,300 to employees. And we know that cash reduced by $1,300, and that become expense, $1,300. So increase expense, salary expense, and reduce our cash. All right. Next, the company received $300 from customers in exchange for 3 months membership to an online health program. Now we're going to receive $300 cash, so cash increased $300. The problem is, what has been increased? It's a sale for membership, but have we provided any service yet? The answer is no, we haven't provided any service. We're in May, that service is for June, July, and August. Therefore, we haven't provided any service and become our obligations to customers, and it's our liabilities. So the $300 will be recorded as a liabilities, to be more specific, and revenue. Okay, and a revenue. So I'm going to increase my cash and increase my liabilities. That's called earned revenue, $300. It's a liabilities. Then the next month, June, by the end of the June, we provided 1 month's service, so we can recognize 1 month's revenue based on these numbers. That's $100 per month, right? So for June, we're going to recognize $100 revenue. July, another $100. August, another $100. We're going to talk about those. Those are called adjusting entries. That's what we covered in the next lecture. Adjusting entries is needed to deal with those unearned revenues. Okay, the company collected $1,200, the amount owned by customers during May. But that's pretty easy, right? We increase cash, and account receivables will be reduced. Another asset's account receivable will be reduced by this amount. Okay. The company paid $40 for interest and repaid $4,000 note payables. So as you can see, the total cash we paid is $4,040. The $4,000 is a return of money, note payables. So we're going to reduce our liabilities for $1,000. Now this $40 is paid for interest, and that become an interest expense. Interest expense. In these transactions, it's going to affect 3 accounts. Okay? 3 accounts. We're going to reduce cash, so we credit cash for $1,040 for sure. First of all, we're going to reduce our long-term liabilities, note payables. So a debit long-term liability note payable $4,000, so reduce it. So we're going to talk about debit and the credit rules. I'm going to summarize that very soon. And I'm going to debit the interest expense account, $40. So it affects 3 accounts for these transactions. Right, so the total debit equal total credit. We're going to talk about that very soon. Next, the company paid $800 for a 4-month insurance policy. It's the same thing like prepaid rent. This is prepaid insurance. We haven't used any of these things. So reduce cash, increase another asset called prepaid insurance. A debit, an asset, prepaid insurance. Right, that's $800. And then credit cash, $800. All right. So the paid $700 in rent for May, and this is for current month. Okay, so we have enjoyed the month of May already. As been consumed. This part has been consumed, so it becomes an expense. It's no longer a prepaid rent. Therefore, we're gonna increase an expense and reduce cash. Debit, rent expense. And reduce our cash, so we credit cash. Okay, once we update all these accounts, we're going to have the income statement. How to update this account, we're going to cover that when we talk about the next chapter, how to make financial statement. Basically, now we have journal entries. These journal entries, well, we're going to use those numbers to update each account. For example, for cash account, right, we're going to update and we're going to get the ending balance for cash account. For revenues, we're going to get ending balance for revenues. So if we put them together, organize them a little bit, we're going to have the income statement. Revenue less cost of goods sold equals gross profit, less other expenses, wage expenses, rent expenses, advertising expenses. We have the operating income, okay, less interest expenses. We're going to have the net income. So we finished income statement. Next, we're going to move to the statement of stockholders' equity, right? With the net income, we're going to update the equities. So to update equities, we're going to determine whether we have paid a dividend or not. And the company did pay the dividend. The company paid $400 for dividend. Paid dividend, reduced cash. Okay, it's also reduced our retained earnings. Reduce our retained earnings, dividend. So we debit dividend. And the dividend eventually is going to be part of retained earnings, reduce retained earnings, and credit cash. Right, that's $400. All right. So once we update the retained earnings, we can have the balance sheet, right? All the assets, liabilities, we have these accounts updated, okay? And for the equity account, this retained earnings, make sure this retained earnings is updated from the statement of shareholder equity. The total assets equals total liabilities. Right, so we're going to see a more complete accounting cycles next lecture, but not for now. This illustrates how we have the financial statement. So the stockholders' equity is a reconciliation of retained earnings from the two balance sheets. Alright, so we have seen the basic idea how to record the transactions, how to analyze and record transactions, but let's learn the debit and credit rules. So we can make sure that we can record all these transactions into journal entries. Alright, so T accounts. We have learned what are accounts, right? Accounts is a place recorded those assets, liabilities, equities, specifically. So in accounting, we're going to draw these T-shaped stuff. We call these T accounts. It's a graphic representation of an account. And we call this T account. And we have account title here, like cash account. And on the left side of this T account, we call this debit. On the right hand side, we call this credit. Debit and a credit. Unlike the debit card or credit cards, here the debit simply means left and the credit simply means right. No other meanings. Okay? So this account, for example, cash, we're going to record a debit number or a credit number. And then the meaning of debit and credit. Now, if we record a debit cash, that's an increase in cash. If we record a credit cash, that's a decrease in cash. An increase and decrease in those accounts are described in this debit and credit rules. And this is required by the double entry accounting systems. Alright, so for all assets account, if we increase the assets account, we debit. So in the T account, we're going to record on the left-hand side. We increase that asset account. If we reduce that asset account, we credit. And we record on the right-hand side. Okay? And the rule for liabilities and equities is just an opposite. Okay? We're going to flip the rules. If we have an increase in liabilities, we have a credit. Decrease in liability, we have a debit. The same for equity. Increased equity, that's a credit. Decreased equity, that's a debit. That's the basic debit and credit rules. And we have multiple assets, multiple liability, multiple equity accounts. So if we expand this accounting equation a little bit, the assets and liabilities will using the same rules. But for equity accounts, okay, be careful, it's a little bit complicated. Because dividend and expense are going to reduce our equities. Common stock revenues increase equities, so common stock and revenues, they have the same rules. Debit means reduce, right? Credit means increase. It's the normal rules. However, for dividend and expense, because they're going to reduce equities, we're going to flip, right, the rule again. So the dividend and expense is going to share the same rule as we have for assets. Increase dividend, increase expense, that's a debit. And reduce dividend, reduce expense, that's a credit. Right, so yeah, it takes a little bit time to understand these rules, but not that difficult. Here we have a summary of debit and credit rules.